We're at the 6-month mark for the year. Has the Denver real estate market seen its peak? Hey everyone, it is Alyson, your real estate strategist and realtor for the South Denver area. It is time for your Denver real estate market update. Let's dive right into the June numbers. June saw 6,500 new listings. That is down 250 listings from the month before. That puts us down 3.5% month over month, but puts us up 3% year over year. 4,100 homes went under contract. That is unchanged from the month before. However, it puts us up 11% from last year. We saw 3,900 closings. That is up 100 closings from the previous month, putting us up 4%, but overall from the year before, down 5%. Inventory went up by another week this month. We are now up 55% in our inventory count over where we were this time last year. The average days on market decreased by 3 days, while the median days on market increased by 1. All right, let's roll into those June home prices. The average closed price for all homes comes in at $711,000. This is unchanged from last month, and year over year, we're up 0.5%. The single family home price average is coming in at $797,000. Up $2,500 from the previous month and up about 1% year over year. The condo and townhome average is rolling in at $434,000, down $2,700 and down 4.5% year over year. Switching over to those median home prices, the median price of all homes sold, $595,000. This is a decrease of $5,000 from the previous month, so down by about 1%. However, year over year, we're flat, same as this time last year. The median price for a single family home is coming in at $660,000. No change month over month, but up 1.5% year over year. The median price for condo and townhomes coming in at $400,000. We've been hovering around this price point for quite a long time. However, last month we were at $385,000, so we've seen a $15,000 increase month over month. That puts us up 4% month over month, but we are still down 1% from last year. And so we're seeing that really we probably are past the peak of the season. Between that data, the fact that we're primarily flat, that we aren't seeing a lot of new listings on the market, we aren't seeing a lot of new under contracts, the peak of the market is most likely behind us. Now, every once in a while we get a blip where a month comes down and we come back up. That typically is not in the coming months. By 4th of July, we typically start to see our market seize up for a little bit. July and August are generally quiet with a little bit of a fall surge before we head into our full downward trend around the holidays. So unless rates want to make a major move and break the market wide open, I think we're going to follow our normal trajectory. Now, what other takeaways do I have for you? If you've been following these updates with me month after month, you see the patterns, right? You are attuned as I am to what has been in the market and most likely what is coming. So bring this into sharper focus as we see the things we've anticipated generally play out. I took a look at several different suburbs to see where we are pricing wise, comparing 2002, which was our peak as we were exiting COVID, to where we are today. Because I am seeing this reality play out as I am comping homes for sellers and buyers. And it is a stark reality, particularly on the seller side, but even as I'm presenting offers on my buyer side. But here's what I see on the suburbs that I priced, just to pick a few. Highlands Ranch, Parker, down about 10% on the whole from 2022 to where we are today. Just comparing this month's data to that month's data in 2022. Castle Rock and Littleton, we see some growth. There were a lot more high-priced homes sold over $2 million this year. When I took those out, we really saw only about a 1% change in Castle Rock. So pretty flat. Littleton, a small amount of growth. Both areas have an abundance of new construction options. As I have shared with you, new builds really can kind of create their own bubble, their own market. They control things and they control price. And what we don't see underneath the hood in the general data till we dig in is what they've done with incentives. Lone Tree has seen a 21% decrease in price over that time, but more than a 50% increase in the number of closings. So when I looked at that, what I saw was an influx in smaller properties being sold in this year versus back in the original set of data. So with a small area like Lone Tree, where you generally are only having a few dozen, generally not more than 30 sales in a month, usually in the 20-ish range, an influx of smaller, lower priced homes is really going to have a large dynamic on that. But I wanted to look, because Lone Tree is one of our more expensive towns, zip codes, areas, and I wanted to contrast and compare that to Cherry Hills Village, Greenwood Village, because that is one of our other premier communities. They have seen 14% price growth. Likewise, Castle Pines is up 5%. The luxury community is holding stronger. There are fewer buyers that are impacted by rates. There is high demand for the properties that meet the needs. And in the custom home community, with the homes not being cookie cutter, what you find is different in every single product. The location, the lot, the shape, the layout. I have clients who are looking for a product in an ideal scenario where they can have a family member who can park in one of the garages, enter into the basement through the garage, and this does exist, so that it's an in-law suite that is not an ADU or some lodging on the back half of the property. They're not on the main floor. They really have full privacy to come and to go out of the garage, and finding that with privacy and quiet, not on a main street in Cherry Hills Village or Greenwood Village. So we're talking almost a needle in a haystack. In addition, my folks don't want to have to put in more than $1 million in work, because some of these homes, because of when they were built, especially with a lot of 90s era kitsch, could use quite a bit of money to bring them up. It's not that the structure is not good, it's the overlay on top of it. So when you find the right thing, they move off the market very quickly. So we're seeing in these markets growth. We're seeing in commodity markets where there's a lot of the same stuff, a Highlands Ranch, a Parker, we have seen a decline. New construction, generally pretty flat. The builders are controlling that, and they're supplementing with incentives that you can't see right off the top. I'm seeing a lot of conversation about how our market is saturated with inventory, how you ought to look back and consider we haven't had inventory this high in the Denver market since 2012, 2013. Here's what I want you to understand. Those years we were coming off our high of 6 months of inventory from the Great Recession. This was not another area, 2012, 2013 were not a time when we were increasing inventory, we were decreasing inventory. So there is really nothing to compare. You cannot conflate these windows of time. Interest rates weren't the same. The market wasn't the same. The mindset was not the same. There is nothing to compare between these windows other than the number, the amount, the similarity in inventory. But I don't find any value for you to go back that far and go, gosh, what can I learn in the market? You're not going to learn anything in that market. In fact, there's really nothing of similarity in our markets in the last several years. This is a brand new market. Even looking back pre-COVID, I've done a lot of 5-year lookbacks with my clients because it takes out that peak, that push, that run, the overbidding, the low rates. But even then, we were just in a good, hot Denver market where homes were selling often with multiple offers, an inventory that was below 2 months, rates that were running about 5, and you could buy it down to maybe 4.9, 4.75 on your own, generally not with concessions from the seller. But at least we're seeing how the market has grown over 5 years and taking out the pandemic component, but it's still not a similar market. In absolute numbers, we actually have fewer homes on the market today than we did 5 years ago. It's just that we have less buyer demand. Closings and pendings are down today by 30% versus 5 years ago. New listings are down today by 20% versus 5 years ago. We have about 6,500 homes, as I mentioned, on the market right now. Back this time in 2019, we had over 8,000 homes on the market. So while the talk is that we have excessive amounts of inventory, that is not the case. It is our environment, it is buyer demand, it is affordability. I mean, comparing prices to 5 years ago, we are up about 40% in this market with rates that are over 6. And it impacts the affordability for many buyers. Yes, buy downs are an option and they are so helpful, but it is still a shock to the system. Everyone who's of age to buy remembers when rates were in the 2s and 3s, and it's very hard to mentally wrap your mind around paying double that rate. And that is what is impacting buyer demand. That said, sellers, do not be sitting there thinking, oh my gosh, I should not sell. In fact, the news for you is definitely not all bad in our market. The last month, 42% of homes sold in the first 7 days. That is showing that buyers are waiting for the right home. I can't tell you how many of my buyers are doing the same thing. They know that patience pays off. On the flip side, well more than half the homes across nearly every price point are giving concessions to the buyer. The only segment where it's not in the upper 40s and beyond is price points above $2 million, and there it's still 28% or more. I'm telling you, every segment is delivering up concessions right now, and in a substantial amount of money. So 1, sellers, be aware of it. 2, buyers, know that it should be part of your negotiation tactics. And 3, sellers, if you don't want to, price it right, show it off, and be one of the homes that sells in the first 7 days, because we do still see competing offers. I have clients who have tried multiple times on different homes and have been one of 3, one of 2, and they're just not willing to dive in hard enough because it's not exactly the house they want. They have the money to get what they want, and they're trying, and so they just keep waiting. Something else to share, tying back to that data I shared about the difference we're seeing in markets since 2022. We are starting to see across the board, it's not just me, I'm not speaking of my clients, I'm speaking of our market. There are sellers who bought in 2022, which was our peak, that are turning around and selling right now and are making no money, very little money, and in some cases have the possibility of needing to bring money to the table to complete the sale of their home. And in the worst case scenarios, they won't have the money to bring to the table, which means they're going to be a short sale. This is not a wave, a pandemic. We're not seeing the start of foreclosures. In fact, a recent study came out in the Denver market that showed there are not signs of the residential market tipping toward an increase in foreclosures. They are seeing it in the commercial segment, but not in the residential segment. But the number of short sales that are emerging into the market when you talk agent to agent is increasing. And this does give opportunity to buyers, but you have to be patient. These are not pretty. You have so much red tape to get through. The companies, the lien holders are not fast, and they can sometimes reject you. So you have to be someone who's not on a timeline, who's maybe renting locally, who has the ability to fly in often to see houses, just has a lot of rope to work with if you want to pursue that avenue. This market is full of opportunity, and it is not all for the buyers. Sellers, if you aren't ready to sell this year, if you're like, no, I wanted to sell in the spring, I didn't get to it, should I sell in the fall? Always sell when the time is right for you, but it's maybe your chance to just start working on your home to get it ready for next season and Denver's new peak time to list. It is moving. So spend the next 6 months working on that. Connect with the agent you know, like, trust, understand when you should be listing next year to capture the most buyers, the best window, and get that home sold. And so many sellers sidelined themselves during the pandemic because of competition, lack of inventory, overbidding, large down payments, cash offers. This is not the market we're in today. So the market you sell in is generally the market you buy in. So sellers, even if you feel like you are missing out on some unrealized gain, like, hey, I could have gotten more money 2 years ago, I should wait. Maybe you should, but if you wait, you may be in a market again where you feel like you are pinched, that buying is hard, that you don't have power, you don't have options. So sometimes it's nice to let go of a little unrealized potential or gain to get a win on the other side. So don't forget about that. If I can be of help, if you want to chat more about strategy, if you're curious about some of this data or others specific to a niche in Denver, please reach out. I would love to connect. And I will see y'all next week.